morning once again, and welcome to the Haven Financial Group radio show. I'm Larry Colvig, founder and CEO of the Haven Financial Group. Feel free to give us a call, 612-504-8400. Visit us online, shoot us an email at info@havenfinancialgroup.com. Kim, we got Lance Larson, our CPA at Haven Financial Group, on for this segment. Before I let him, I wanted to take a takeaway from that first segment.
Sure.
You know, a lot of that might have been overwhelming. We covered it quickly, those timelines and the to-do list. But the good news is, Kim, listeners don't have to do it alone. If they have a good partner to lean on and that can keep them up to date with all the rules and the laws and the changes and all that stuff, they don't have to do it themselves. So again, have a good partner. We would love to be that partner. And again, we got Lance Larson, our CPA. We're going to talk about tax planning, checklists, and what to do, because taxes are just so much fun, aren't they, Lance?
They are.
My fear is that Lance actually believes they are.
He does.
Great to see you, Lance, like always. I'm so glad you're here. We're talking about, end of year, holiday time. And there's, this isn't necessarily the time of the year that everybody wants to be thinking about some of these issues, but this is a good time of the year as we wind down 2025 and we get ready for 26. I thought we'd talk a little bit about account contributions and some of the things that maybe you need to walk through here at the end of the year to make sure that you're where you want to be. One of the big things here, gentlemen, is that people need to know what the contribution limits are at the end of the year and maybe make some preparation for what they're going to be the following year. So maybe you could walk us through the limits of 2025, let's say on your IRA contributions.
So the limits, Kim, they are going to be dependent upon what retirement account that you're contributing to. So for people at work, most people have a 401k. And so the 401k, they have a bigger limit than your individual IRA right there. Mm-hmm. So for the IRA, the limit is going to be $7,000 plus a $1,000 catch up for those over 50. Now that limit is both for the traditional IRA and the Roth IRA and it's not 7,000 each, it's 7,000 between the two of them.
Okay.
So now we look at it and say, all right, for those over 50, we have a maximum of $8,000 that we can put into an IRA, whether it's traditional or a Roth. Then we actually need to start looking at other contribution limit factors, such as if you are covered at a retirement plan at work, then can you make a deductible traditional IRA contribution? Are you making too much money that you might not be able to contribute to the Roth account as well? Mm-hmm. So there are going to be some other limiting factors that are going to be based upon income and whether you're covered at a retirement plan at work.
Okay. So a traditional 401k is $23,500, correct?
Correct. That's the basic level for everyone right there. Then we have the additional catch up for those over 50.
Right.
That's going to be another $7,500 for the 401k.
Okay.
So when we talked with the IRA, it was a lower limit at that 7,000 versus 23,500 versus at the 401k. Mm-hmm. Now we have a catch up, which is only $1,000 at the IRA. It's $7,500 for the 401k. And then in addition, the 401k, people who are age 60 to 63 have a super catch up. That $7,500 turns into $11,500.
Oh, terrific. Great. These are a lot of numbers, I know. And for people who are listening, immediately you just kind of go, my head is spinning. But why is it important, Lance, for people to understand here at the end of the year or as they're going into 2026? Why is it important for people to understand, what the limits are or to get some information so, they can make their planning? Why is that so important, though?
Well, the first thing, Kim, is that there are limits that if you are over contributed, now you can actually be subject to penalties. Okay. That's probably the biggest thing right there, is that if you put too much in, whether it's a 401k or what I see a lot is actually people putting too much into their health savings account, their HSA. But any of these accounts that you can contribute to, if you over contribute, you will now be subject to an excise penalty on the overcontribution. And then you have to do something about it. You have to take it out. So that could cause future tax problems for you that you're not planning on. Because say you put in there $50,000, just as a nice round number. Well, you are definitely over that limit. Now you have to get that money out. But when you put it in there, it was a tax deduction for you. When you take it out, you have to pay the taxes.
Right.
Now you just given yourself future taxable income.
Right. Absolutely. And because taxes, I think, is an area that everybody's very interested in. Let's talk a little bit about at the end of the year here, if you're trying to make some decisions about in 2026 where you want to put your money that would give you the greatest tax advantage when it comes to these kinds of retirement accounts. What do you suggest to people?
I'd say look at where your income levels are at.
Okay.
So the first thing you're going to look at is when your taxable income, again, we talked about the tax brackets before, that on the federal side, we're at 10, 12, 22, then 24. So if you want to pay minimum taxes, in retirement, most of the time we can keep a lot of the retirees in that 10 and 12% tax bracket. So if you're looking at your income and saying, hey, my income this year is going to put me into the 22 or the 24% tax bracket, well, it makes a lot of sense to do a traditional where we get the deduction today because we are going to get a deduction at that 22 or 24% tax bracket versus someone today who's working that is in the 12% tax bracket. It might make more sense to do a Roth contribution at that point because we don't necessarily need that deduction today. Let's have that grow tax-free and get free tax money in the future.
Sure. This all sounds interesting, but confusing for some people. When you sit down with new clients, first off, at what age do you want to see them making these kinds of tax decisions? And what do you do if maybe they've made decisions on their own that maybe will not be advantageous in the future?
To answer the first question, I would love to see them right when they're in their 20s to help them get on the right path. Now, with that being said, a lot of time we were dealing with retirees, they've made their decisions like you talked about. That's kind of water under the bridge. We can't go back 20 years ago and make different changes because sometimes the rules didn't exist at that point. Roth accounts are a relatively new thing. A lot of the time we went from you had a company paying your pension back in the 60s and 70s to now in the 80s and 90s, companies started forcing their employees to manage their own retirement. And so we have these traditional ones. The Roth accounts, they weren't for everybody. They weren't available at that point. So I want to say the people who want to say that, oh, I wish I would have done this. Well, stop looking backwards because those rules didn't exist back then. Let's deal with what we have now. And so that's to answer your other question. What do we do with it? We look at where you're sitting at today. We make the best decisions that we can today with the rules that we have. This is when we have the opportunity. We talk a lot about these Roth conversions. So if someone is making income that's still in the 12% tax bracket and we still have these wiggle rooms, hey, let's take some of that traditional stuff that you did in the prior years and then let's convert that to a Roth today. Those are the type of things we like looking at.
Kim, if I could add, the good news is, and I think it's how Lance and Haven differentiates from others, is Lance's favorite thing is the whiteboard. He loves to explain things and make it so people understand. I can't tell you how many times a year folks walk out of his office and go, nobody has taken the time to explain it to me in a way that I can understand. Now, you don't have to be the expert, but we explain things at Haven. We help people understand why they're doing what they're doing. We had newer clients that we were referred to. They're from Elko Newmarket. Just this past week, we sat down with them, high income earner. They're on the right track. They've had a life journey just like a lot of us have. But guess what was fitting for them here as we were planning is a backdoor Roth. They go, we would have never, ever known anything about this. High income earner can't contribute, but we did a backdoor Roth that made complete tax sense. And they would have missed it just like a lot of people miss it because most people nowadays are not tax planning. They're simply getting their taxes prepared.
Right.
They're not even seeing their tax preparer. And that is not enough attention as you approach retirement and in retirement. That's the wrong approach. Sorry to say, that's the wrong approach. And I think people should change that.
Well, we're going to talk more about tax planning and how important that is at this time of year. It's important all year round, but certainly important as we come to the end of the year and the beginning of the new year. 612-504-8400. That's how you get hold of the folks at Haven Financial Group. Lance Larson is our guest. He's a CPA there at Haven, and he's going to stay with us as we talk about tax planning, your checklist here at the end of the year. So you stay with us as well, folks. This is the Haven Financial Group Radio Show.